Good afternoon, everybody, and welcome back after yet another ice cream session. I hope you've had your fill. If you've not, we have another session even after this. So hold your horses. And to those on the webcast, I can only apologize saying, hey, you missed a real great ice cream treat. My name is Abhijit Bhattacharya. I'm the CFO of the Magnum ice cream company. A little bit about myself. I was the CFO of Royal Philips for the last 10 years. I had the good fortune of being part of the team that transformed Philips from an industrial conglomerate to a healthcare-focused company. Did a lot of M&A at that time. We acquired 30 companies, but we also divested 7, 8 big entities. I had the good fortune of leading a lot of them. When I counted, this is my 6th large carve-out. I was part of the carve-out of NXP, which is a semiconductor company, but also the television business of Philips, the IPO of lighting, which was Signify, the domestic appliances business. So actually when Peter called me and said, do you want to be part of forming the largest ice cream company in the world, it was very difficult to say no. But I had to cross his magic threshold because he said, if you don't have 10 years of consumer experience, you don't make the team. I worked for 12 years in the consumer business, so I said, okay, that works. So Peter said, come on board, and here I am. What I'm going to attempt to do in the next 40 minutes is to tell you a little bit. You heard the plan, you heard the actions we are taking. What does it mean in terms of numbers? Because ultimately, I guess most of us have to see that it all squares. After that, we suspect that there may be a couple of questions, so we have time for Q&A, and then after that, again, the next round of ice cream. So what holds you back between the ice cream is just my presentation for the next few minutes. What do I want to tell you? You saw in the regional presentations that a lot of the numbers are delivering, right? You saw that, yes, we had troubled times in the US, we had difficult period in Europe, but performance increased. I will show you how that works for the full company. I want to share with you key parts of the self-help plan that we have to drive margin expansion. I think that's critical to understand that a lot of it just depends on us, and we have a fantastic execution team which is working on it. I will give you color on the capital allocation policy and how that supports our growth strategy. And last but not the least, I will give you some detail and color in terms of the targets that we have set for ourselves, both internally and of course committed externally, but very importantly, there's complete clarity in the organization as to what we want to drive in the coming years. If I move to our performance till 2024, you see that, from a volume point of view, we have been losing over a 10-year period, we have been losing volume. It's the first time it came back last year. You see the same in terms of market share. Losing steadily, not by big chunks, but now we've turned the corner. Most importantly, you see that as you lose top line and volume, you lose margins. That's the problem with our business, but that's also the opportunity, because if we drive volume growth, we will get margin expansion. And last but not the least, after a flat EBITDA for a number of years, you see a step up of 100 million last year. So that shows that the plan is already working. I want to show you a bit of a balanced scorecard, not just on these parameters, but across the board in terms of growth. And you see that we grew 2.8%. And now I'm going to introduce a little bit of complexity in all of this. the numbers we present to you is the carve-out numbers that we have based on how we separate on day one, which is in the middle of November. We don't have India in these numbers because that comes later. So for those of you who saw the 3.7% growth in the reported number of Unilever, you know where the difference comes from. Most importantly, we got back to volume growth. And I will compare ourselves later with a peer group, and you see that we are really at the top of the table in terms of getting back volume growth. Market share, and I will show you a few slides on market share as well, but important, gross profit, adjusted EBITDA, both up, and the margin up by 100 basis points last year. We've been talking about our productivity program. I will give you some details, but you see that this is not something that is a PowerPoint that still has to be implemented. This is up and running, and 70 million already in the P&L last year, another 80 in the first half of this year. So 150 done, but still a long way to go. As part of the productivity that we are doing, we also get benefits in our working capital. And you see our inventory days reducing last year, continuing to reduce this year. I will show you that. And the promised step up in Capex that we've already started putting in, because that is what is causing our growth engine to start moving. What you see here, and this is an important chart, you see that the improvement that is happening in the company is happening across the world. This is not driven in one pocket in Asia or a pocket in Europe, it's happening across the world. You see the step up in profitability is strong in the Americas and in AMEA. Europe had a big productivity program but challenged with the cocoa price increase, but still managed to step up. So across the board, we are getting back to good growth. But looking at ourselves and comparing ourselves to ourselves doesn't really matter unless you're winning in the marketplace. And this is the chart. If you look at the dark line, appropriately, I think, colored in the color of chocolate, you see that we have been consistently delivering on the market share improvement. We started the trend in Q1. We were still down but improving. And over the last 4 quarters, we have been continuously gaining. An important point that Peter made, people often ask about private label. If you look at a 10-year period, their shares in the market have been flat. So they have a place to play, but it's not that they're coming after the bigger players or that you are able to challenge, let's say, the bigger established players. Now, this was 2024 and a bit of 2025. How have we done in the first half of 2025? First quarter, 4% growth, half of it in volume. So I picked up a few questions on volume, etc. This is a key indicator for us. Q2, 7% growth, 5% from volume. It's a big number and a big growth, and also competitively a big advantage that we've started to now really clock in. And I'll now show you exactly the same dashboard for the first half of the year. You see the 5.8% growth. You see the volume growth in the first half of 3.5%, which is more than half the organic sales growth. And you see us continuing to gain market share. You may question me, hey, your profit is down in terms of gross profit by 4 million. And the EBITDA margin is down 30 basis points this year versus last year. Very, very important to know. We had a headwind of 340 basis points in the first half of the year. Unprecedented, 340. 290 from commodity prices and 50 basis points from FX. So if you see that, we have actually been able to neutralize 310 basis points in half a year. And that would not have happened if we didn't have our pricing machinery working and our productivity engine delivering. On top of that, you see that the inventory reductions continue. and the step up in Capex. We did, 43 million last year. We did half of that already in the first half of this year. So we are putting our money where our mouth is, and that's reflecting back in the performance of the company. This is the dashboard. Let us now compare ourselves to the peer group. And if you look at this chart, this has organic sales growth over a 2.5 year period. You see 2023, you see 2024, and you see the first half of 2025. You see in 2023, we were at the bottom of the pack. In 2024, we moved up to second, and in 2025, we are at the top of the pack for the first half. But most importantly, for 2024 and the first half of 2025, we have the highest volume growth in the peer group. What does this mean for profit? Because if we drive top line, we have the productivity program under control. What does it mean for profit? Same format, 2023, we were bringing up the tail. We lost actually 70 basis points when others were making money. Last year, we were almost at the top of the pack, 5 bips behind. And this year, everybody of our peer group is feeling the pressure of commodity prices. We have been able to mitigate by far the largest amount as anybody else in the peer group. Let me now move on to the next part, which is our overall strategy. Peter spent some time this morning giving us, let's say, the overview of what we are doing. I will go a little bit into detail on a few elements. The first pillar is growth, and I just want to emphasize that that's a key pillar of our overall strategy. Why do I say that? Because we have built that into our incentive programs. As you saw from Ronald's presentation this morning, the short-term incentive has growth, the long-term incentive has growth. Both are critical. If you, for example, have one tough year, you still have to make, in that period, your growth target so that you are able to catch the LTI. The second important part, and you will see that when I present the capital allocation policy, we have factored in the investments that we need to drive growth. It is in the financial plan that we will present. You saw this slide from Peter this morning, and I just want to provide a little bit of clarity on what we are doing for growth. So if you look at the past couple of years, we were around the 3%, just shy, and we are now planning to move to the 3 to 5% range. The important point to say here is that this is an annual average improvement in a market that grows 3 to 4%. So the market grows 3 to 4. We expect on an average over the medium term to deliver 3 to 5. That could be in a year which we are at the higher end of the guidance, could be a year where we are at the lower end, but on average, this is how we expect this to pan out. The three biggest levers, I know we've said this earlier in the morning. Somebody once told me that the power of advertising is in repetition, so let me try again. Innovation and occasions are our biggest driver of growth. You see that? Availability expansion, you heard about our cabinets, the money we want to put to further grow our distribution. And last but not the least, we have some fantastic brands. They are in particular geographies. We have the ability to grow them in other geographies. You saw many times the reference to Yasso this morning. We have done the first customer tests in Europe. They've come out extremely well. It's a business that grows, I think, 22-23% CAGR over the last 5 years in the US. If we are able to replicate that success in the rest of the world, really gives us a boost to drive growth. On sales, I'm going to cover one more on growth and sales. one more slide which may take you by surprise. The slide may look a bit complicated, but let me walk you through it. On the left-hand side, what I've attempted to do is to look at how seasonal we are, because the often discussion around ice cream is, yeah, you're a volatile business, and oh, is the sun shining today? Are you in a good mood? Actually, if you look at it overall globally, we've looked at it here for 15 years, but if you look at the last 20 years, for the period May to September every year, we do between 53 and 55% of our sales. You see the dark line there, it's flat as a pancake. You could have great years in Europe, they're compensated somewhere else, but this is a seasonal business, but it's not volatile. What we cannot predict accurately yet is what happens between the months. Is there going to be rain in June? Is it going to be July? Is it going to be August? And that gets capital markets a bit kind of nervous. But if you look at the period, it's actually very, very stable. Now let me draw your attention to the right of the slide. And there you see us compared to other beverage companies. And why do I take beverage companies? Because there you see the volatility closest linked to weather. And for each company that we have taken, there are two lines. So for the time being, let's focus on the line on the left. It shows you from the period 2019 to 2024 in Q2 alone, the kind of peak and trough sales that has happened in that time. And you see for the beverage companies, it's a factor 2 or 3 times higher in terms of volatility when you compare it to the Magnum ice cream company. If you look at the bars which are just to the right of it, it's in the shaded area. That's the part where we've taken out the COVID period, because people think, yeah, there's COVID that may have spoiled the numbers or have created a favorable impression. We've done both. We said with COVID, without COVID, you see that the volatility is less. And we are working on a few things to further ensure that over a period of time that the seasonality is more spread out through the year. We are working on the geographic mix, because let's say the seasonality is highest in Western Europe, less so in the rest of the world. The channel mix, you heard the rapid growth in DCOM. That happens, that's indulgence buy, that happens irrespective of how cold or hot it is. But also the portfolio mix. As we drive more in the premium zone, more indulgent, you see that is less and less seasonal. I'll come to the next part, which is productivity, and give you some color as to what we are doing. So we have a 500 million productivity plan. You see the plan, the 70 million we delivered last year. You see cumulatively how we build that up in the next few years. This productivity plan is the gross saving plan till 2028, and there are 3 big buckets. The first one is on the supply chain transformation, the second one is on overheads, and the third is on tech-enabled productivity, and I'll give you some color on each one of these 3 blocks. Within supply chain, we have, again, 3 big blocks. One is optimizing our end-to-end network cost. I'll give you a few examples. The second is driving manufacturing productivity, and the third is procurement efficiency. What does end-to-end network optimization mean? We have actually a fantastic footprint of factories around the world. We have, you may hear 2 numbers, 30, 36, that's because of the perimeter. Let's say going forward we have 36 factories around the world. We don't need to build new ones, but the factories were actually optimized for lowest cost of production. When you optimize a plant for lowest cost of production, you make as few SKUs as possible so that you have less changeovers and then you distribute. For a business like ice cream, the cold chain that you transport products on has a significant cost element to it. So the right way to do this is actually to look at the end-to-end cost. And when you look at the end-to-end cost, you realize that the factories we have should actually be producing many more SKUs but serving a smaller radius of customers, so that your ice cream is not traveling a lot. In the US, our ice cream travels on an average 770 kilometers. If we bring that down by 20%, we get 100 basis points on margin alone. So that is the big changing productivity that we are driving there. And the other important one is debottlenecking of the factory. So for example, we have a factory where if your packing line is manual, you can produce ice cream at a level of 100, pack at a level of 80. You cannot produce the 100 because otherwise you can't pack it. These are small investments which we need to make, and that gives us, for a fraction of the cost, 20% capacity. And this is happening as we speak. So in terms of network, for example, in Europe, we are reducing our distribution centers from 29 to 10. So we are cutting it by 2/3. So that is, again, you produce in factories a wider range of products. They travel less. You have lower inventory because you have lower stocking points. And then we have smaller distribution centers for last mile distribution, which helps you really to bring the cost down. So that's a big thing. I'll give you another example. We were in our factory in Covington in Tennessee, and there are issues around labor, and therefore we were again constrained in terms of our packing capacity. We have now automated that line, and it gives us 8% additional capacity in the whole plant. We have another one in our, maybe I give you the Ben & Jerry's example. We used to produce all our Ben & Jerry's for the US out of Vermont. We have moved 25% of that production to Sikeston. Sikeston, by the way, is the largest ice cream factory in the world for anybody, not just us. And once we've moved it there, we are able to distribute now from Missouri, and therefore again bring costs down. So it's quite a big program that we are running. In terms of manufacturing productivity, the big war there is the war on waste. We had a rejection or a waste percentage of 6% couple of years ago. That means you take 6%, you make the ice cream, and because it's either not packed or not produced properly, you have to throw it away. We have, in the last couple of years, brought that down by 25%, and by 2028, we will bring that to just below 3%. You saw earlier today Taichung at 2%. If we get all our factories to around 3%, that's just 100 bips in gross margin just on waste alone. I think the most exciting part is on procurement, because being part of Unilever and looking at the Pareto of big purchases you do, you don't get the same importance that you get when you just look at the ice cream category. So we have really, in 4 categories, we have very, very strong category teams who are specialists in cocoa, in dairy, in sugar, and in energy. And they make their curves, etc., in terms of what they expect. On a weekly basis, Sandeep, me, and Peter, we sit together with the teams and decide what we are going to cover for, what we expect market developments to happen together with the team, and it gets the highest level of attention in the company. And with that, you are able to do quite a few things that we couldn't do earlier. The other point is that we have much more flexibility also on hedging. So we are now able to look into next year, and not just in terms of futures, but also in terms of collars. We see where cocoa prices are going, and we are now actually pretty well covered into next year, which is something that earlier we were restricted in terms of time frame that we could go. So that's another big thing. And last but not the least is indirect procurement. We think that that's a big opportunity. We are looking at outsourcing the big package to a service provider who does it for many companies, and therefore you get much better rates, but also discipline in the way we spend our money. These are the three big initiatives we have there. The second big pillar I told you was on overheads. And you see that in overheads, we built a company that has 92% of people who make, move, and sell ice cream. Therefore, the part that actually works in the headquarters, which is primarily focused on strategy, capital allocation, talent allocation, dealing with capital markets, etc., is very, very narrow. And we've put all the functions into the businesses, into the regions, so that they have end-to-end accountability for the P&L and the infrastructure that goes along with it. The last bit is on the tech-enabled productivity, and I think that's a big question that often comes up because it's a big transition that is happening. We started early, and I think that's what gives us the advantage. We started planning for this in the fourth quarter of last year. So we are almost complete with the design phase. We have actually already started implementing, so our treasury management system, our money flows through the company, operates on our new treasury management system. Our consolidation for July and August runs on our own systems. And then the ERP, etc., are in the process of being built. So the design, like I said, is mostly done. We will now build and then deploy over a 2-year period. This actually supports us in the global business solutions that we are building as well. This will help us also to move out of the temporary service agreements or the TSAs that we have with Unilever. And we are looking at a broader scope. So include not just, the usual finance and HR back office stuff, but also in areas of digital services, marketing, and many more. And we are building a couple of hubs around the world. We've just signed with the government of Maharashtra an MOU to set up a big global business services setup in Pune in India. We will set up one in Central Eastern Europe and one in Mexico. I think the biggest advantage that you get here is, apart from the big ERP implementation, if you have a lot of your back office processes running in one location, the use of hyper-automation, agentic, etc., really gives you efficiency at scale. It's something that I've done before. We've recruited Florence Mui, who has done this for 3 large multinationals. So we are really up and running and ready to implement. Last but not the least is the reinvestment that we are going to make. 2 big areas. One is on Capex. You see here that about 40% will go towards growth. There is the cabinet expansion we talked about, the innovation, but also the capacity expansion, not in terms of new factories, but the debottlenecking that we have to do. The other 40% is on productivity. The savings of 500 million are not going to come for free. So that I explained that in detail. And then, of course, you will have a remaining 20% which goes into quality, compliance, and ESG-related expenses. The other area that we are looking at is our spend on advertising and promotion. And what I'd like to leave with you is 3 things that we are focused on: digitizing, social impact, and better activation. So instead of spending a big chunk of the money on producing assets, we need really to have a lot of it in activation. And that line, as we go more and more towards social, is getting blurred with the influencers and others that get used to this. The first priority in this is not to jump from 12.4 to 13. The first priority is actually to spend the 12.4 better. And if we need to up that amount, our financial plan and balance sheet give us that flexibility. The other area, of course, is working capital. I've spoken about it a couple of times. The inventory reductions that we are doing, our receivables is actually in a very good place. We hardly have any overdues. So we collect on time. We have good payment terms which we adhere to. And we work on negative working capital. So as we grow sales, that negative working capital will grow, and that gives us a little benefit into our free cash flow. So what does this mean for the free cash flow? The biggest contributor is the improvement in profitability, and this is the bridge that we've kind of built to give you a good idea of what are the main drivers. The main driver for closing the profitability gap, medium to longer term, is the driving of volumes. Yes, there is a certain amount of price inflation, most of it which gets covered by pricing. You heard Gerardo saying that he wants to get into areas like the dollar clubs and the value channels. For that, we have to run the productivity program so that our cost of the product becomes low enough so that we make good margins. So part of it is reinvested. Over a longer period of time, we believe we have the strength in our brands to offset inflation with pricing. So basically what you get is then the volume mix and overall productivity, which is going to drive the increase in margins. In this plan, we have for material related inflation about 2.7%, and for non-material related about 3%, would be about 2% if you exclude Turkey. Turkey, given the hyperinflationary nature and the fact that it's our second largest business, has a big impact on the overall mix. So this happens to the EBITDA. I want to also mention here, just for clarity, that this is the average annual increase that we are going to drive over the period. Again, you could have years which is a little bit less, year which is a little bit more, but this is the average that we are driving, and as we come to the years, we will give more clarity. What does this do for cash flow? I think quite a significant step up. If you look at the average cash flow between 22 and 24, we were around the 6 billion. You see that we will plan to go in 28, 29 between 0.8 to a billion. That's roughly a 50% step up. Most of it coming from the improvement in earnings and a very good free cash flow conversion. So cash flow conversion to our net income will be high. What does this do? This higher return, etc., actually put us in a starting position of a very good return on invested capital. We are at 23%. A lot of people were surprised by this number. I got a lot of questions, is goodwill included, not included, whatever. Everything is included. The goodwill that we have for brands like Yasso, etc., are all included. This is the ROIC. It will have a temporary effect of going down a bit because we will have to acquire the business in India. That will add a little bit of goodwill. A couple of other countries, we will also make investments, but we will still be in and around the 20%, which is a fantastic return for our business and among our peer group. I also want to leave you with a few important points about our business as we exit from Unilever. Our hard currency, soft currency profile is significantly different from Unilever. We have 70% of our business operating in hard currencies. So what Peter showed you earlier as well. Turkey, yes, is hit by inflation, but we have demonstrated the ability in a hyperinflationary situation to price accordingly. So when the local market prices go up, we are able to price, and Turkey is about 8% of the remaining 30%. The second important fact is that more than 90% of our businesses are local for local. So therefore, the discussion on tariff is, let's say, not as relevant for us as a lot of other industries. If you look in the US, we are above 92% local for local. And then the last one is a lot of interest in, how big is cocoa exposure, how big is dairy exposure. You have it all here. 22% of our overall material and packaging cost is cocoa. If you look at that as a percentage of sales, is about maybe 8%, give or take. So then you have a good idea of what it is and how we manage it and what could be the impact. But be aware also that this is an industry impact. It's not just a Magnum ice cream company impact. Couple of more things which people are often asking me is about the separation cost. We will spend about 800 million on separation. More than half of it is on technology. So Mark, who is here, who's our Chief Information Technology Officer, has a lot of money to spend, but he has also a big delivery to give us. We work very closely with him and the team. Important also is that 80% of the separation costs would be incurred by next year, which also means that our separation will happen at a very rapid pace. We are looking to exit all TSAs by 2027. And we will have restructuring costs in the bandwidth of 75 bips to 80 bips. Let me also update you on where we stand regarding separation. It's a very complex process around the world, multiple legal entities, factories, etc. We are a separate standalone legal company operating already from 1st of July. So this is something important to note, that it's not something to happen, but we are operating, of course, fully owned by Unilever. Another important part is that we have agreed on a net debt to EBITDA leverage ratio, and that is at 2.4, which puts us nicely in the investment grade rating. We have obtained the credit rating from Moody's. Maybe between the time that I walked on stage and I will walk off, we may get it also from S&P. The lawyers are, wouldn't say arguing, but discussing the last words of the press release. But there we should be in a good place. I think you've all seen the announcement that Unilever will retain a 20% stake. I think that clearly signals the confidence that Unilever has and the support that they will give us to ensure that this transition is done in the best possible manner. And most importantly, not only have we signed the TSA agreements, we are actually now already in the month of September beginning to exit some of the TSA. So the exit plan is pretty rapid, and I will show that to you on the next page. Bulk of the TSA is on IT costs, 60%. And why have we done this? Because we have chosen the most de-risked approach to separation. If we had rushed this, there could have been instability in the business. We continue on Unilever systems. We worked out a way where the data, etc., is fully separated within our control, and over time we will start the rollouts of our own ERP system. There's 15% in terms of finance and supply chain back office that will transition to us as we ramp up our global business solutions. There's a little bit in real estate which we share, and then 20% in other smaller things like fleet management, etc., which we are exiting as we work the new contracts. So this, you see, again, by end of next year, we would have exited 70% of the TSAs. And that's pretty rapid because, for a company which has its day one in November this year, within a year, we would have exited 70% of our TSAs. Let me then take you on to the capital allocation policy. I want to repeat, our strategy is based on driving organic growth. and therefore we have ensured that the financial plan has the right amount of investments we need. We will have a very competitive dividend policy compared to our peer group. We have a payout ratio of 40 to 60%. The first dividends we will pay out for next year in 2027. I heard a few questions do we have to wait 2 years for dividend? Absolutely not. Since we are part of Unilever for almost all of this year, the dividend for this year for the ice cream business and all of Unilever will be paid by Unilever. And then from next year, as we run the full year, we will start paying dividends. So there is no dividend holiday in the plan. We do retain the ability of doing bolt-on M&A where we need to. So that's also important. If there are opportunities that come in particular areas that we want to invest, we have the flexibility to do that. And we think that by doing this, we give a good balance between attractive shareholder returns, but also maintaining a solid grade investment rating. And that brings me to the overall financial framework, which is the growth of the top line of 3 to 5% on an average, the margin expansion, 40 to 60 basis points, strong improvement in free cash flow, a very, very competitive return on invested capital, a strong balance sheet with investment grade leverage, and an effective tax rate of 25 to 27%. That's also roughly in the range of companies that are doing the kind of business mix that we have. So what I want to leave you with is that the strategy that you heard all through the day is actually delivering results consistently over now an 18-month period. We have a self-help plan that we are working on and also significantly are advanced on. The capital allocation policy and the questions that people had, now you see that in terms of a balance sheet, we exit with a very respectable balance sheet in a very cash-generating business, and the targets that we've set for ourselves. So before I move to Q&A, maybe to sum up the day, because we've been here for a while and you've heard multiple stories, we play in an attractive market. The market grows 3 to 4%, good and attractive returns, and the snacking category is very attractive. We have a lot of strengths from the get-go. 160 years of experience and expertise in the company, which is really an invaluable asset. Strong brands, world-class capabilities, big part of local manufacturing, and a hard currency, soft currency mix that puts us in a very good space. We've also said that the separation is good for both companies. I hope by now we've made clear why it's an advantage for ice cream. We have the flexibility of tailoring our supply chain and operating model to the cold chain required for ice cream. And we are focusing our investment algorithm on what is needed for ice cream. And what does that give us? Gives us good growth and profit expansion through self-help measures, and then gets us to the targets that we have set for ourselves. Before we go to Q&A, I have 2 points to make. You've seen on your table that there are some questionnaires. Please take a couple of minutes to fill them in, because it gives us very valuable feedback in terms of what we can do to make this more rewarding for you and help us improve. There is, of course, a great incentive at the end of it, because if you hand it in outside at our registration desk, there's a fantastic goodie bag that you get as well. And that goodie bag doesn't have ice cream, but you can have ice cream on the way to the goodie bag. The second most important thing is you saw on Ronald's slide that 92% of our employees believe in the future of our company. That has really improved. I really hope that this group is even better than the 92%.